Welcome back to the Deep Dive, where we tear apart complex research and business frameworks, distilling them down to genuinely useful, memorable knowledge.
Today, we are cracking open something that's really the central nervous system of any successful organization: corporate finance.
I like that, the central nervous system.
It is. I mean, this is the field where every lofty strategy, pioneering R&D, opening a new market, anything, it all has to be translated into measurable dollars, into risk assessments and allocation decisions.
It's where the rubber meets the road.
Exactly.
Yeah.
It's where ambition meets the cold, hard reality of capital.
Okay, let's unpack this. We're diving into a master summary of fundamental corporate finance concepts today. And our mission, really, is to give you the precise mental model used by CEOs and CFOs all over the world.
Right. We're going to distill it down.
We're going to get to the three core decisions every financial manager has to make. We're going to define the unambiguous, quantifiable goal of the firm and expose the inherent conflicts that can sometimes sabotage that goal.
You should think of this deep dive as your shortcut, really. A shortcut to understanding the financial logic behind every major corporate headline you read.
Oh, that's a good way to put it.
Yeah. When a company announces a massive acquisition or a stock buyback, you'll be able to understand the precise financial question that decision is answering, and critically, whether the management is actually acting in the owner's best interest.
All right, let's get into it. Before we zoom in on the financial manager's daily struggle, let's just map the territory. Finance is enormous, right? We're talking trillions of dollars moving around.
Every second, yeah.
So how do we distinguish corporate finance specifically from, the wider world of money management?
That's a crucial distinction. It really is. We tend to use finance as this catch-all term, but it really breaks down into, let's say, 5 defined areas.
Okay.
The first, and our main focus today, is corporate finance. This is the engine room of the business. It's about managing the firm's own money, its operations, its strategic investments. It looks inward.
So decisions made by the company for the company.
Precisely. Now, you contrast that with what most people think of when they hear finance, which is investments.
Right, the Wall Street image.
The constant hustle of trading, risk assessment, portfolio management, asset allocation,
Wow.
Handling stocks, bonds, derivatives. It's outward facing. It's about optimizing returns from assets outside the company's core business.
Got it. And what's the third area?
Then you have the financial institutions. These are the crucial intermediaries. The massive banks, the insurance companies, mutual funds.
They're the plumbing of the system.
That's the perfect analogy. They are the plumbing. They channel capital from savers who have money to borrowers who need money. Without them, the whole system just grinds to a halt.
And when you take all of this global, that must add a whole new layer of complexity.
A massive one. And that brings us to the fourth area: international finance. This just layers on risks that purely domestic businesses can often ignore.
Like what?
Primarily the volatile complexities of currency exchange rates, and then you've got cross-border transactions, and of course the inevitable political and sovereign risk that can just destabilize a solid business plan overnight.
And you mentioned 5 areas, or 4.5.
Right, the half area. That's FinTech. It's the new technological overlay on top of all the others.
The blockchain, crypto.
Blockchain, crypto, tokenization, robo-advising, algorithmic trading. You name it. It's actively disrupting and reshaping how those traditional 4 areas operate. It's less a standalone field and more, I'd say, a new methodology that's changing everything.
Okay, that's a really clear map. Now let's bring it down to the individual. If you're listening and you're a brilliant engineer or a great marketing director, why do you need to know this stuff? Why isn't this just siloed with the CFO?
Because the business is an interconnected system, that's why. And financial knowledge. It's the universal language of resource competition inside that system.
Resource competition, I like that.
Every single strategic goal, whether it's R&D or a new training program, is a demand for capital. If you don't speak the language of capital, your best ideas are going to lose out in the internal fight for funding.
Okay, let's make that concrete. Talk about marketing.
Sure. You might have the most creative campaign in history, but you need financial knowledge to build an accurate budget and, crucially, to prove a return on that investment, the ROI.
To justify the spend.
To justify the capital expenditure. I mean, A marketing department that's proposing a $20 million campaign isn't just asking if it will generate sales.
For asking something much more specific. So.
Much more. They're asking if the expected future cash flows from those sales will exceed the $20 million they spend. When you discount those future cash flows back to today's dollars, and you have to use a rate that reflects the firm's cost of capital.
The hurdle rate.
The hurdle rate. If marketing can't frame their proposal in terms of net present value, they're essentially asking for a blank check.
And what about accounting? They're the scorekeepers. They should already know this, right?
They know the rules, but they have to understand the substance behind the numbers, the economic reality. They can't just log transactions.
Give me an example.
Okay, so a company decides to finance its fleet of delivery trucks using a really complex long-term lease instead of just buying them.
Okay.
The accounting rules for how that lease gets reported. Is it an operating expense or a capital obligation on the balance sheet? That depends entirely on the substance of the financial decision the manager made. If the accountant doesn't get the strategic intent, they can't properly report the firm's obligations.
And for management, I mean, this seems obvious.
Yeah.
This has to be the foundation of everything they do.
It is the absolute foundation for corporate strategy and long-term planning. You cannot set a credible 5-year expansion goal if you don't understand the capital requirements, the optimal financing mix, debt versus equity, all of it.
You'd be flying blind.
Completely. A manager who ignores finance might accidentally bankrupt the company by choosing the wrong legal structure or by, I don't know, chasing short-term accounting profit by laying people off and destroying long-term value. Understanding finance is what moves you from just doing the job right to doing the right job.
Yeah, that really sets the stage. So all of this analysis, all these pressures, they all land on one person's desk, the financial manager.
That's right. This role, which is usually the treasurer reporting up to the chief financial officer, the CFO, carries an immense fiduciary responsibility.
Meaning they have a legal duty to someone.
A legal and ethical duty to act specifically and unequivocally in the owner's interests.
And they do that by constantly answering 3 huge interconnected questions. These are the pillars of corporate finance, right?
They are the 3 pillars. And let's start with the first one, which many people consider the most strategic and frankly the most challenging one. Capital budgeting.
Question 1, capital budgeting. What is it?
It's the long-term investment decision. Definitionally, it means deciding which long-term assets, which new product lines, which machinery, what massive R&D projects the firm should commit its capital to.
This is where the future of the company gets decided.
Literally. And the analysis isn't just a simple spreadsheet comparing costs and revenues. The core focus is on analyzing the size, the timing, and the risk of the expected cash flows from these potential investments.
Okay, the size is obvious, but why are timing and risk so critical?
It all comes down to the time value of money.
$1 today is worth more than $1 tomorrow.
$1 today is worth more than $1 received next year. Always. So if you invest $50 million today, you have to get future cash flows that are not just more than $50 million, but they have to come in soon enough and with enough certainty to make the whole thing worthwhile.
So how do they measure that?
The main tool is discounted cash flow analysis, or DCF. And within that, the key calculation is for something called net present value, or NPV.
Okay, let's pause there because everyone throws around the term NPV, but I don't think everyone really gets what it means. What does a positive NPV actually tell a manager?
A positive NPV means the project is expected to generate enough cash to pay back the initial investment.
Yeah.
To cover the firm's required rate of return, which is its cost of capital that accounts for the risk.
Okay, cover the cost of the money.
Right. And still generate an additional surplus of value for the owners. So any project with a positive NPV should, at least in theory, be accepted. It adds shareholder wealth.
You know, the material really emphasizes that these decisions are often irreversible. If a firm builds a $500 million specialized factory, they're committed.
They are committed. That makes the risk assessment just terrifying.
It has to be the scariest part of the job.
It really does. I mean, it requires visionary foresight. Once that concrete is poured, the opportunity cost is immense. So that risk assessment, the process of figuring out the discount rate to use in your NPV calculation, is absolutely vital.
So you'd use different rates for different projects.
Oh, absolutely. A manager might be looking at 2 projects. One is a low-risk utility expansion, and the other is a high-risk biotech startup. They must use a much higher discount rate for the biotech venture.
Because it's more likely to fail.
Exactly. Which means that project has to promise significantly bigger and faster cash flows to get to the same positive NPV as the safer project. If you use the same rate for both, you are fundamentally misallocating capital.
Okay, so the manager has run the numbers. They've found a positive NPV project, a new factory, let's say.
Yeah.
They've made their capital budgeting decision. Now what?
Now they immediately face question 2, capital structure.
How are we going to pay for it?
That's it. How do we pay for this thing we just approved? This defines the exact mix of long-term financing that you use, and it's the fundamental existential trade-off in corporate finance: debt versus equity.
All right, let's break that down. If we choose debt, we borrow money. We have a legal obligation to pay interest and pay back the principal.
No matter what, even if the business is tanking.
And if we choose equity, we sell ownership shares, we dilute the current owners, but we don't have that immediate payment obligation. So why would anyone ever choose debt? It sounds like you're just begging for bankruptcy risk.
One huge reason: the tax shield.
The tax shield.
In most places, the interest payments you make on debt are tax deductible. So the government is effectively subsidizing a portion of your debt costs.
And dividends to shareholders.
Dividend payments to equity holders are typically paid out of after-tax profits. There's no deduction. So debt is cheaper.
So debt is cheaper because of the tax benefit, but it's way riskier because of that contractual payment. How does a manager find the right balance?
They're searching for the optimal capital structure. It's that sweet spot where the marginal benefit of the tax shield from adding $1 more of debt is exactly offset by the marginal increase in the risk of financial distress or bankruptcy.
So different industries would have very different optimal structures.
Totally different. Stable industries, like utilities, often carry very high levels of debt because their cash flows are super predictable. They can maximize that tax shield benefit.
And a tech startup.
A volatile tech or biotech firm, where cash flows are completely uncertain, will rely much more heavily on equity to keep that bankruptcy risk as low as possible.
This choice also comes down to control, doesn't it? Equity dilutes ownership. Debt doesn't, as long as you make your payments.
Exactly. When you issue new equity, you're selling a piece of your corporate democracy. If the current owners are fiercely protective of their control, they'll lean towards debt. If the firm is young and needs growth capital, they might favor issuing equity to venture capitalists or the public, even if it means giving up a lot of control.
Okay, so we've decided what to buy and how to pay for it. That brings us to the third question, which you said is less dramatic, but maybe the most common cause of failure.
Yes. Question 3. Working capital management. This is all about managing the firm's short-term assets and liabilities.
The day-to-day stuff.
The day-to-day. Cash, inventory, accounts receivable, that's money customers owe you, and accounts payable money you owe suppliers. It's about making sure the business stays liquid.
So you could have the world's best idea and a rock-solid balance sheet, but you could still go under because you can't make payroll.
It happens all the time. The manager here is wrestling with the cash conversion cycle.
Meaning?
How long does it take to buy raw materials, turn them into a product, sell that product, often on credit, and then finally collect the cash from the customer? The manager has to decide, how much inventory do we hold? How generous are our credit terms? How quickly do we pay our own bills?
And each of those is a trade-off. A big inventory is great for sales, but it's just cash sitting on a shelf.
It's dormant capital. And generous credit terms are great for customers, but you're effectively giving them an interest-free loan.
Right.
So the manager is trying to find this equilibrium between profitability and liquidity. Hold too little cash or inventory and you risk shutting down operations. Hold too much and you're sacrificing profitable long-term investments. It's a constant battle.
So those are the three decisions. Now let's talk about the legal wrapper around all of this, the structure of the business itself, because that dictates how these decisions affect the owners and how easily they can get the money in the first place.
Absolutely. And it all comes down to one concept: liability. Liability is everything, especially when you're starting out.
So at the simplest end of the spectrum, you have the sole proprietorship and the general partnership.
Right. Easiest to start, minimal paperwork, maximum control for the owner.
Yeah.
But the price you pay for that ease is the massive, severe drawback of unlimited liability.
That sounds terrifying. What does it actually mean?
It means the law sees no difference between the business and you, the owner. Every business debt, every lawsuit against the company, it all exposes your personal assets.
Yeah.
Your house, your savings, everything is at risk.
Wow.
And a partnership is just the same thing, but you're multiplying that unlimited risk across multiple people. So these structures are simple, but that personal risk is a huge barrier to serious growth.
Which is what pushes successful businesses towards becoming a corporation.
It's the logical next step. And the corporation is a monumental legal invention. The law treats it as a distinct legal person. It can borrow money, own property, sue and be sued, all in its own name, separate from its owners.
And the biggest benefit of that is limited liability.
That's the cornerstone of modern capitalism. If you buy a share of Apple, the absolute most you can lose is what you paid for that share.
Yeah.
The company could collapse, but your personal assets are completely safe. That's what allows corporations to raise billions of dollars.
But there's a big downside, right? A penalty.
A very hefty price,
Right.
double taxation. The government taxes the corporate income first at the corporate level. Then, if the corporation distributes what's left to shareholders as dividends, the shareholders get taxed again on that income at their personal rate.
Ouch. A double hit.
It's a major financial drag. And to try and get around that, we've seen the rise of the modern hybrid, the LLC, or limited liability company.
Trying to get the best of both worlds.
That's the design. It gives you the limited liability protection of a corporation, but it generally allows the income to be passed through to the owners to be taxed only once, like a partnership. It's become massively popular for that reason.
So the legal structure is critical because it determines how easily the manager can get the money they need. Which brings us to the financial markets themselves. How does the money actually flow?
The flow is split between two types of markets, primary and secondary. The primary market is where the original sale of a security happens.
Like an IPO, an initial public offering.
An IPO is the classic example. Or a startup selling shares in a seed round, or an established company issuing new bonds. The key point here, the most crucial point, is that in a primary market transaction, the firm receives the cash.
That's the money that fuels all those capital budgeting decisions.
Exactly. That's the fuel for growth. Now, the secondary market is where those securities are resold among investors.
So when I go on my brokerage app and buy a share of Amazon,
You are buying it from another investor who already owned it. You're in the secondary market.
and the point that's so often misunderstood here is that the firm, Amazon in this case, gets no cash from that transaction.
Zero. The money just moves from your account to the other investor's account.
So if the company doesn't get the money, why should the financial manager care so deeply about the secondary market?
Because it performs two vital functions that allow the primary market to even exist. First, liquidity.
The ability to sell easily.
Right. Investors need to know that if they buy a security, they can sell it later without a huge hassle or a massive price drop. Without a healthy secondary market providing that liquidity, no one would buy in the primary market in the first place, or they'd demand a huge discount.
And the second function is price setting.
Absolutely. The millions of shares trading hands every single day determine the current market value of that company's stock. That price is the ultimate report card for management.
It's the metric they're trying to maximize.
It's the goal. It signals to everyone how investors feel about their decisions. A high price makes it cheaper to raise money next time. A low price is a direct warning that management is failing.
The sources also quickly mention two main types of exchanges where this happens. Dealer versus auction. What's the practical difference?
The dealer market, which you'd associate with NASDAQ, is electronic and decentralized. Dealers are like merchants. They hold an inventory of stocks. If you want to buy, they sell to you from their inventory at their asking price.
And if you want to sell?
They buy it from you at their bid price. They make their money on that little gap between the bid and the ask, the spread.
And the auction market, like the New York Stock Exchange.
The NYSE is highly electronic now, of course, but its structure is still fundamentally an auction. It aims to bring all the buyers and all the sellers to one central place or platform and match the highest bid with the lowest offer. A market maker oversees the process to keep it orderly. So one focuses on matching orders, the other on dealers providing instant execution from inventory.
We've established the decisions, the structure, the markets. Here's where it gets really interesting. Because all of those levers, all those choices, are aimed at one single, quantifiable goal. It's time to define the true, unambiguous objective of corporate financial management.
The sources are crystal clear on this. The goal is to maximize the current value per share of the existing stock.
Not just stock price, but the current value, which is interesting. So why isn't the goal just maximize profit? That seems so much more intuitive.
It sounds intuitive, but maximizing accounting profit is actually a terrible metric for a financial manager. It's profoundly ambiguous and, frankly, very easy to manipulate.
How so? Give us an example of how chasing profit can be destructive.
Well, it fails on three fronts. First, timing. Like we said with NPV, $1 next year isn't the same as $1 today. Accounting profit doesn't care. It treats $1 million in profit today and $1 million in profit 5 years from now as exactly the same.
Which they're not.
Not even close. Second, risk. A manager could chase a high-risk project that might generate a huge profit, but has an 80% chance of completely failing. The accounting numbers might look good if it works, but the stock market will hate it.
Because the market will price in that risk immediately.
The market will immediately discount the expected profit to reflect that huge risk, and the stock price will probably fall. And third, what even is profit? Short-term or long-term?
Right.
A manager could slash R&D, sell off critical assets, and defer all maintenance just to get a massive but totally unsustainable boost to this quarter's profit. The stock price, though, would plummet because the market can see they're destroying the company's future just for a one-time gain.
So maximizing stock price forces you to think about all those things at once: timing, risk, and long-term health.
It forces you to. The market price acts like a continuous real-time audit of all your decisions.
Speaking of audits, let's talk accountability. The sources bring up the Sarbanes-Oxley Act of 2002, SOX. This was a direct response to huge scandals like Enron. How did SOX try to enforce this goal of creating real value?
SOX dramatically increased the personal accountability of management. It required stricter internal controls, and it mandated that the CEO and CFO personally certify the accuracy of the financial statements.
So they couldn't just say the accountants handled it.
No. Lying suddenly carried very real, very severe criminal penalties. Specifically, it was Section 404 that created this massive new compliance burden. It required management to document and test their internal controls, and then it required external auditors to audit not just the numbers, but the controls themselves.
That sounds expensive.
Hugely expensive. It required massive investments in IT systems and paying enormous audit fees, and there was this unintended consequence for some smaller public companies.
They decided it wasn't worth it.
Exactly. They looked at the millions in annual compliance costs and decided to go dark, to delist from the public exchanges and become a private company again. They traded the liquidity of the public market for massive cost savings.
But even with SOX and this clear goal, we still have to face the most persistent, the most human issue in all of corporate governance: the agency problem.
This is the fundamental conflict of interest it's baked into the modern corporation. You have this agency relationship. The stockholders are the principals, the owners. They hire managers who are the agents to run the company for them.
And the problem is their incentives aren't always lined up.
That's the agency problem in a nutshell. It's when managers start prioritizing their own comfort or their job security or their personal perks over maximizing value for the actual owners.
And we see examples of this all the time.
All the time. Think about the manager who insists on a lavish new corporate headquarters in a city with great golf courses but terrible logistics, or scheduling a key meeting in Hawaii. They're diverting corporate resources to maximize their own personal utility.
The source is called the negative impacts from this agency costs.
Right, and they break down into two types. First, you have the direct costs. These are the easy ones to spot. The corporate jet, the fancy parties, but also the costs of monitoring management, like paying for expensive external auditors just to keep an eye on them.
But the more dangerous costs are the indirect costs, the lost opportunities.
And this is so much bigger. This often shows up as extreme risk aversion. Imagine a manager who's close to retirement. They might avoid a really profitable, positive NPV project if it has even a small chance of failing spectacularly.
Why?
Because if the project succeeds, they get a small bonus. But if it fails, they lose their job right before retirement. So they protect their own job security, their own comfortable status quo, but they destroy potential future wealth for the owners.
It's a quiet sabotage. So how do you fix this? How do you align their interests?
There are two main solutions, and they work together. The first is creating a really sophisticated stock-based compensation plan.
You turn the manager into an owner.
You make them a co-owner. You give them stock options, restricted stock units, bonuses that are tied directly to long-term share performance. Now, when the stock price goes up, they get rich. When it goes down, they feel the pain right alongside the shareholders.
And the second solution?
The second is maintaining the constant, credible threat of external control. If the current management team is failing, if their stock price is just sitting there because of all these agency costs, the firm becomes a very attractive target for a hostile takeover bid.
A low stock price is like a for sale sign that says, this company is being mismanaged.
It's a giant flashing sign saying, there is value here that could be unlocked with better management. The fear of a new owner coming in and firing the entire complacent team is a very powerful disciplinary force.
Okay, this framework leads us to some deeper critical thinking. The goal is maximizing stock value. Why should anyone who isn't a shareholder care about that?
That's a great question, and the sources offer a strong defense based on the idea of the residual claim. Shareholders are the residual claimants. They get paid last.
What does that mean, practically?
It means everyone else has a contract that gets paid first. Employees get their wages, suppliers get paid for their invoices, the banks get their interest payments. If the stock value is rising, it means the value of that leftover, that residual claim, is growing.
Which implies the company is healthy enough to have paid everybody else first.
It implies the company is so healthy that it's satisfying all its prior obligations and still has a growing surplus of wealth. So maximizing that share value is actually a really good proxy for running a successful, sustainable business that benefits all its stakeholders.
And that sustainability piece connects directly to ethics, which the sources frame not just as a moral issue, but as a hard financial one. Ethics as financial risk.
It's pure risk management.
Yeah.
Unethical, behavior polluting, exploiting labor, committing fraud, it creates immediate and massive financial risks. Reputation loss crushes sales. Lawsuits and fines can destroy a company.
So maximizing long-term value requires you to act ethically.
It absolutely does. A manager who cuts corners on ethics for a short-term gain is just introducing huge long-term uncertainty, and the market, as a risk assessor, will punish the stock price for that.
Let's apply this to that high-stakes scenario you mentioned, a hostile takeover. A hedge fund offers $60 per share for a stock that's trading at $45, but the current management fights the bid.
This is the ultimate test of the agency problem. The owners are being offered a massive premium, but the agent's management are trying to stop them from getting it.
They're clearly just protecting their jobs.
Overwhelmingly, that's the motivation. The only justifiable defense management has for fighting that bid is if they can prove with credible internal data that the company's real fundamental value is actually higher than the $60 offer. If they can't, they are actively sabotaging their own employers.
Last question on this. How does this whole framework translate internationally? Is it a universal model?
The goal itself, maximizing value adjusted for time and risk, is universal. An investor in Tokyo wants the same thing as an investor in New York, the best risk-adjusted return. But the methods of getting there have to adapt to local laws, culture, and, of course, currency risk.
So corporate governance structures might be very different.
Very different. In the U.S., shareholder rights are paramount. In Germany or Japan, you have stakeholder models where labor unions or banks have a major say. The financial manager has to navigate all of that, plus the added complexity of forecasting exchange rates. The job is the same, but the chessboard is way more intricate. If we connect this to the bigger picture, corporate finance really provides the structured, critical framework for turning abstract ideas into sustainable, wealth-generating realities. It forces managers to discipline their thinking.
To think in terms of size, timing, and risk.
Yes, all culminating in that single, measurable outcome. Maximizing shareholder value, which really is the most effective metric we have for judging the long-term health of a company.
So what does this all mean for you, listening to this? This entire framework, the three big decisions, the focus on stock price, that ever-present agency problem, is now your toolkit.
It's how you evaluate what a company is doing.
Exactly. It's how you evaluate any public company's strategy and the performance of its leadership. When you read a quarterly report, you now know that every big decision in there is an answer to one of those three questions.
And that leads us to a final thought, tying the goal and the conflict together. We talked about stock-based compensation as the solution to the agency problem.
Right, paying the CEO in stock to align their interests.
And while high CEO pay is often defended as just the market price for top talent, it raises a really important question. Does the common structure of that pay, the heavy reliance on short-term metrics or stock options that vest very quickly, does it truly solve the long-term problem?
Or does it maybe create a new one? Does it incentivize managers to just chase short-term stock bumps, things that might actually erode the firm's long-term health?
That is something for you to consider the next time you read a headline about executive compensation. Is the structure actually solving the agency problem, or is it creating a new, more sophisticated, and maybe even more destructive one?
Thank you for joining us for this deep dive into the fundamentals of corporate finance.
We'll see you next time.